All right, what's up everybody? My name is Sleem and I'm the CEO and founder of Sleem Stock Picks LLC. Today I'm going to be going over moving averages because there seems to be a lot of confusion for new traders as to which ones to throw on your charts, how to even do that, and how they're calculated. So if you learned something from this video, feel free to like, subscribe, comment any questions below. And on top of that, check out our free week trial of our membership if you want to learn even more. Okay, so let's get started. All right, so moving averages, why do they matter? Essentially, moving averages can act as support and resistance in any situation. So, a lot of day traders use the 20 SMA, so the 20 simple moving average, as a support level. A lot of swing traders and long-term investors use the 200-day SMA as, a key support or resistance level. Okay, so a lot of the times you'll see a stock downtrending, 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 and then touch the 200-day simple moving average and bounce off, in which it would act as support. And vice versa for resistance. So it can also act as a trend indicator. So moving averages often, can tell you what the trend is looking like, which direction we're going, despite, all of the chop that's on your screen. So if you're seeing candles with low volume or, they can't really pick a direction, or bars, however you chart, then a trend indicator can be thrown on your chart, a 5, 10, 20 SMA. That'll tell you exactly which direction the stock is moving without, crowding it with all that different chop. Okay, and last but not least, buy and sell signals. That's what our profits boil down to. So a lot of traders, not just long-term investors, a lot of traders use their intraday charts for buy and sell signals. And that being said, a lot of the chart indicators that they use are just simple moving averages or exponential moving averages. And I'll explain the difference to you between those two in a second. But essentially, they'll throw a lower period moving average, a 10 or a 20, and then when it crosses above the 50 or below the 50, they will buy or sell the stock. Okay, and then when it crosses back, they'll do the exact opposite. So it can, indicate a shift in the trend and a shift in momentum, and you can buy and sell stocks just based off of two lines crossing. Okay. So I'm going to show you exactly how they're calculated, and that way you get a better feel for exactly what they are instead of just seeing a couple lines on your screen. All right, so I went onto Yahoo Finance and I pretty much just took the different highs, lows, and closing prices for the past 20 days. So I can show you how to calculate the 20 simple moving average. Okay, so essentially how you calculate it is pretty easy. It's just the sum of all of these closing prices divided by the total number of periods. So that would be 20. Okay, so let's take the sum of those closing prices just with a simple Excel formula. So 2,255.35. And then let's take that and divide it by 20 to give us our 20 SMA of 112.767. So that is the 20 simple moving average for Apple. That can act as support and resistance. That can tell you whether or not the stock is trending higher. And, it can help you give a buy and a sell signal depending on what other moving averages you have plotted on your chart. Okay, so another way that you can calculate this is, using the high and the low, the highs and the lows for those periods. Okay, so this is the most common way, just using the closing prices. But a lot of times people want to take into account any, abnormal ranges, any unusual ranges during that time period. All right, so if Apple spikes to $200 for a day and comes back to 112.63, then it's going to completely throw off the moving average because it's not accounting for that spike. So if you want that range accounted for, you can do the high plus the low divided by 2 and average those prices opposed to just averaging the closing price. So let's take the sum of that. So I'm going to sum up all these prices, and of course we have two different sets of values, so we have to divide them by 2. So equals this sum divided by 2. Now we've come down. You can see the differences in the numbers. This 22.53 versus 22.55, obviously the ranges were a little bit smaller. All right, and now we take that number. Sorry, let me put it down here. We take that number and divide it by 20, and that gives you, a simple moving average factoring in the ranges for those periods. Okay, so it's barely lower, but for some traders that makes all the difference, and it can give you more timely buy and sell signals depending on what you're trading. Okay, now, as you know, when a simple moving average or a moving average in general appears on your chart, it's a line. Okay, it's constantly updating with each period. And the reason for that is because, every single day, these values are going to change and it's going to alter this 20 SMA. So let's throw in a 21st day here. All right, ignore the highs and the lows. And let's just say Apple skyrockets to $150. Wouldn't that be nice? So, as you can see, if we were to take the sum of these periods, now we are not only ignoring the first day, but we have added in another one. So it's taking the 20, recent periods. So that would be 2 through 20 and this 21 right here. All right, so we would have to take the sum of these values, and that would ignore the first day, skip right on over to it, to this guy. All right. So now that sum is obviously a little bit different, and that's our new 20 SMA. Our 20 SMA has gone up $2, which is a dramatic move for a simple moving average, especially one over that long of a period. And the stock had skyrocketed to 150. So this is a big move for the 20 SMA, but on top of that, it's not as big of a reaction as you would hope for. If you're using buy and sell signals based on moving averages, the 20 SMA is going to take longer to update, and as you increase that length, from 20 to 50 to 100 to 200 day SMA, it's going to take, longer to react to any big price movements because it's taking so many different values into account. Okay, so that's why something with, a 3 simple moving average or a 4th simple moving average is going to be dramatically impacted by any type of big shift in these numbers. Okay, so that's how the simple moving averages are calculated. And that's something that you have to take into account when you're using them for your buy and sell signals, or even, as just support and resistance levels on your chart. Okay. And simple moving averages are pretty common, but another common thing are, exponential moving averages, which are a completely different ballgame. But essentially what exponential moving averages are just, simple moving averages with different weightings, to the most recent prices, so that they have a faster and, heavier reaction to any type of big shift in the price. So if Apple were to jump up to 150 tomorrow, then the exponential moving average would move dramatically higher than just 114.995, that 20 EMA, because it gives a heavier weighting to the most recent prices so that it reacts faster. Okay, so the downsides to EMAs, just to give you a brief overview of those so we don't have to dive too deep into it. While they are faster, they can be choppier and they can give you a lot more head fakes. The whole point of moving averages are to either, read the trend or, find buy and sell signals. So if you're getting head faked left and right because it's giving a heavier weighting to these guys, then you're going to get scared out every single time around. And that's the difference between using, a 3 simple moving average and a 20 simple moving average. The 3 simple moving average is a freaking roller coaster ride. You're just jumping and dropping and jumping and dropping all the way to the end. Okay, but a 20 SMA is a lot more smooth. It's a lot more relaxed. You don't have those big price reactions like you'll get from a shorter period. So an EMA kind of has the cons of a shorter period SMA, just because it gives a heavier weighting to the most recent prices. Okay, so this is all just basic mathematics. And some guy got smart and decided to put it on a chart, and here we are. All right, so that's how they're calculated. Let me show you what it looks like on a chart. All right, so now I can actually give you a visual as to what's going on. So let's add a couple simple moving averages. And, if you're using Thinkorswim, you've never done this before, just go to Studies, Edit Studies. And then we're going to throw some simple moving averages on. So let's put one on to start. Okay, and let's put this as the 20. Okay, apply it. And here you can see that just with the 20 SMA, you can get a good feel of what the overall trend is for the past 20 periods without dealing with all this crazy chop. Okay, so As you can see, Apple's been trending higher since, these lows over here trended higher, dropped lower, trended higher. And you can see that if we zoom in, it has a little bit of a delayed reaction to this bullish move. We don't actually start sloping upward until later on. All right, and sometimes that might cause you to buy in a dump. So it's good to plot other moving averages on your chart as well. Okay, so the 20 SMA is a good read of the overall trends. And actually the most common SMAs while I'm here are the 50 and the 200. And people use them as buy and sell signals, also referred to as the golden cross when the 50 crosses above the 200. So let me put the 50 in green because it's a buy signal when it crosses above. And let me put the 200 in red. All right, this is a very common method for long-term investors or, even just swing traders. Okay, so as you can see, the 50 crossed above the 200 here, so this is when you would buy. And we can't really see it on the daily chart, but if we take it out to the weekly, this is different time periods, you can see that there really haven't been any sell signals on the weekly chart whatsoever. The sell signal being the 200-day crossing below the 50 SMA. All right, so back to the daily, we can see volume flowed in right after this golden cross here, obviously for the announcement and whatnot. So there was volume coming in for that too. But technical traders definitely entered on the 50 crossing above the 200. And you can see that the 50 is reacting a lot quicker because it's, a shorter time period. It's a shorter length. Okay, so for those 50 periods, it's going to update a lot quicker than something with 200 averages to take. And you can see that the 200 SMA acted as resistance once, twice, and this is a big deal. A drop for Apple, the last retest it had after this drop, it dropped $30 before it popped back up. So it's a big deal when a 200-day SMA knocks down a stock or, acts as a support level. Okay, so the 200-day SMA and the 50-day are the most commonly used ones. For exponential moving averages, it's the 12 and the 26. Works in the same way. They're just a little bit faster, and that's typically geared towards day traders. Okay, so let me show you one last example. If we throw the 50-day, and let's just throw a 3. Sorry, what am I doing here? Simple moving average. And let me make this 3. All right, let's put this on the 1 day, 1 minute time frame. So before we were looking at something with, on the daily chart. So each moving average takes the averages of the closing prices for the day, whereas this is now the closing prices for each minute. So every single candle. Okay, so as you can see, the 3 has a very quick response time. It's choppy. It's not a clean cut buy or sell signal, whereas the 50 is just smooth. Tells you exactly where the trend is, exactly where the stock is heading, and even though it takes a little bit longer to react, it keeps you from getting scared out of a stock and it helps you read the trend. Okay, so that's the difference between, a smaller length moving average and, a much larger length moving average. So, in review of what we've learned so far, simple moving averages can, act as resistance, support, trend indicators, buy signals, sell signals. But there are also exponential moving averages, and more than that too, but these are the two most common. And the most common ones are the 50 and the 200 day for the SMAs, and then for EMAs, the most common ones are 12 and 26. Understanding the calculation for them is really important. The EMAs just give a bigger weighting to the most recent periods. And overall, it's just the sum of the closing prices, if that's what you choose to use, because it is the default, divided by the total periods. Okay, and EMAs can be faster and a little bit choppier, whereas SMAs, can be a little bit slower, but are great for reading trends. And at the end of the day, it's all about what works for you. So personally, I like using the 20 SMA, the 50, the 200. Some traders like using the 4 and 6 EMAs, the 8 EMA. They like using Fibonacci numbers for some of their moving averages to forecast and, factor in the retracements that they're using. So A lot of people use different systems for their charting, but personally I like to keep it simple. So find what works for you. Don't put a million technical indicators on your chart. You're either a good trader or you're not, but it is good for buy and sell signals. So moving averages are crucial for trading. I use them all the time, and I think any great technical trader uses moving averages. So if you guys got any questions about them, or you want to learn more, feel free to reach out to me and just comment below. All right, thanks so much, guys.